Hi everyone. So welcome to the live stream today. Very much excited for having you on the second session as we look at the various things that we need to consider in order for us to take our lives and career to the next level, and most importantly, in order to pass the examination. And I see some of you guys already joining the stream. You are welcome. Comment in the chat box any questions you have for me. What do you want me to share my thoughts on as I take you through a couple of issues today in our discussion for the exams. And yesterday I got a couple of questions coming up, and I'm going to be starting from there and addressing those questions in there. Then also I'm going to be sharing my thoughts on the various questions that are going to be coming up today. So I see some of you guys joining. You are welcome. Comment below with any questions you have for me, and share the video. Let us reach as many students as possible. Give us a thumbs up on the video when you join. It helps us a lot so that we can reach a lot of students coming on the live stream. So put in the chat box any questions you have for me on YouTube. Put in the comment section any questions you have for me on Facebook, and then let's get a discussion going in that case. Let's get a discussion going in that case. So let me open my slide on yesterday's discussion and the kind of questions that came up, and let's see if we can start sharing some thoughts on some of the questions that came up yesterday as I pick some questions from you guys as well today. Right, I see some of you with a thumbs up on the video. Thank you very much. I really appreciate that. It helps us a lot so the video can reach a lot of other students like you preparing for the examination, so we can together assist a lot of students. So yesterday we had a discussion, and people asked questions about various issues that we need to look at, various issues that we need to consider. And I want to share my thoughts real quick on some of the questions that were raised yesterday, which I mentioned will require a lot of time for me to share my thoughts on in that case. Okay, so I see a question coming in from Gil Christ saying, hi Nhyira, how do we treat a sale of non-current assets to a subsidiary at a profit or discount? Okay, so let me start from the question from Gil Christ, and I see some of you guys joining. You are welcome to the live stream. Give us a thumbs up on the video when you join, and put in the chat box in the comment section any questions that you have for me as we go into the discussion real quick today. So this is financial reporting and corporate reporting. So sale of assets by the parent to the subsidiary. So parent is selling the assets to the subsidiary. How do you do the treatment on that? Very simple. Now, the parent selling the asset to the subsidiary is going to sell the asset at a profit. So what is going to happen is that we will calculate the provision for realized profit or loss. Are you getting it? And that provision for realized profit or loss will be deducted in the group retained earnings. In the group retained earnings. Then any excess or more reduction in depreciation that will be calculated will be taken to the associates profits for the year, will be deducted from the subsidiaries profit for the year. I don't know if you get that. I'm going to take it again. This is what I mean. Since the parent is the one selling to the subsidiary, what is going to be happening is that the parent is going to be calculating provision for unrealized profit or loss. That provision for realized profit or loss will be deducted from the parent's group retained earnings, because the parent had not made that profit yet for the period under consideration. Then because the subsidiary buys the assets, they are going to be charging either more depreciation or less depreciation. So let me contextualize with a question. Let's say that the carrying value of the asset is 10,000. Let's say that the fair value of the asset is, say, 17,200. Or let's just say 17,000. Okay. Now let's say that the remaining useful life of the asset is 10 years. Are you following me? So follow me carefully here. So let's say that when that happens, what is going to happen in that regard? When this is sold, it means the parent is making a profit of what? 7,000. So we calculate provision for unrealized profit on the sale, and that's going to be the 10,000 minus the 7,000, and that's going to be $3,000. And we are saying that this provision for unrealized profit, we deduct it from the group retained earnings, since the parent is the one selling. So this one will go to the group retained earnings. It goes to the group retained earnings. Now, what we are saying here is that in the subsidiaries books, they will be charging depreciation on the 17,000. Now, when you take the company as a whole, it's a single company. There is nothing like parent on sub. So on the group level, it is one company. So if it is one company, then the depreciation is supposed to be charged to on the carrying amount, which is 10,000, and not on the fair value, which is 17,000. For that reason, we're going to be calculating an excess depreciation, and that excess depreciation would have to be added back to the profit of the subsidiary. So for instance, the subsidiary will be charging depreciation based on the fair value as 17,000 over 10, and that will be 1,700. But that is not the depreciation they should have charged. So the depreciation based on the carrying value will be 10,000 over 10, and that will be 1,000. So it means there is an excess depreciation that they are charging that they are supposed to have charged, which is 700. Are you getting it? Which is 700. Please, the provision for realized profit here is supposed to be 17, not 3,000. I think this 17,000 minus 10,000. So that is going to be 7,000. That's the group retained earnings. Okay, that's the group retained earnings. So now the excess depreciation 7,000 will be deducted from the profit for the year of the subsidiary. Then we go and subtract it from the assets of the company in that case, or the group statement of profit or loss, statement of financial position in relation to that. So what do? Double entry. Now, since this is an excess depreciation they are charging, that is a depreciation that they are not supposed to have charged. They are supposed to charge 1,000 on the group level, but they are charging how much? 17,000. So what is going to be happening is that we're going to be adding back the excess depreciation to their profit. We add back the excess depreciation to their profit. That is the idea here, because they are charging more depreciation than they are supposed to charge, so their profit is falling. So you add back the profit in that case. So Gil Christ, Hamenu, that is the treatment for sale of assets. Assuming it was a loss, the same workings will be done, and we'll reverse the entry with what has been done in that case. So Gail Christ, let me know if that makes sense for you. And I see some of you guys also joining us on Facebook. You are welcome. Share the video. Let us reach as many students as possible. And also comment in the chat box any questions you have for me in that regard. Sharifa bin Palmer said, hi, Shira, good evening. Hope you are doing great. Yes, Sharifa, I'm flourishing. Then what you say that Timothy said, good evening, sir. We are here again. You are welcome. Thank you. And you're also welcome. Please, it's sole sourcing and single sourcing the same under procurement method. Yes, technically it is the same in relation to that. Technically is the same. Okay, technically is the same in that regard. Technically is the same. But there is some difference that we can talk about. The difference is that, for instance, when you are dealing with sole sourcing, it usually takes place when only one supplier has the item that we want to buy. Okay, so if only one supplier renders the service or is selling that goods, then in that case, we will use the context of sole sourcing. Okay, but then under single sourcing, it is where a particular supplier is purposefully chosen by the entity, even though there may be other suppliers available. Are you getting the idea? So it looks like you are buying from one person, but it depends. When the person is the only one rendering that service or selling that goods, we say sole sourcing. But then if the entity decides to buy the goods from a particular customer, sorry, from a particular contractor or supplier, then that is called single sourcing. So that is the idea about that. That is the idea about that. So Timothy, like I said, on the generic level, we use them interchangeably, but they have a bit difference in that case. Like I said, sole sourcing, only that supplier is doing that thing. So it's like the person is an expert, is a guru. But with single sourcing, there could be other people available doing the same thing, but the entity decides that based on A, B, C, D, we are buying from this particular customer. Then it becomes single sourcing in that case. So that is the slight difference that we can say in relation to that. Let me know, Timothy, if that clarify your question for you. Sharifa said, please, there is a question on lease whereby the rentals are paid semi-annual. How do we treat this? Yes, I think that was mentioned yesterday as well. I'm going to be seeing if we can come to that in a moment. John Malongo said, my big teacher, Nhyira, many greetings from Tanzania. Right, greetings to you as well, John. Gil Cry said, I'm okay. Thank you, Nhyira. You are welcome. Ebenezer Kwanzaa said, greetings from Takrade. Okay, you are welcome and greetings also to you. Osmanu said, hi, sir. Good evening. Hello, Osmanu. Good evening. You are welcome. John said, can you elaborate on the key hints regarding public sector auditing? When you say key hints regarding public sector auditing, what exactly do you mean? Because when it comes to public sector auditing, one of the things that you need to look at is the issue in relation to one, the role of the Auditor General. That is very, very critical there. So the role of Auditor General, because remember, when it comes to the audit service, the Auditor General is the head of the audit service. So we need to know the constitutional role of the Auditor General in that regard. Then we need to also understand the issue in relation to how the Auditor General carries out his audits. The Auditor General carries out his audits by looking at value for money, financial irregularities, how transactions are prepared or accounted for in the book or in the books of the company, whether value for money is being achieved, and all of those things. Then we need to also know about internal audit units. Internal audit units in the public sector is what we know in the private sector as internal auditors. What is the role of them? And it is the role of the internal audit agency to ensure that each MDA or MMDA actually has an internal audit unit in place in consultation with the Auditor General. Then we must also know the role of the Public Accounts Committee in public sector auditing. We must know the role of the Audit Report Implementation Committee. This is like the audit committee in the private sector, the role they play. We must know all of these ones as well in that case. So when you say a hint of public sector auditing, I mean, it's a broad area, but these are the thematic issues that you need to understand in that case. These are the thematic issues you need to understand in that case. Then we are seeing another question coming up. Osmanu said, please say, how do we treat lease payment that have yearly in arrears? Yes, I think that was the same thing Sharifa brought up in a moment ago, and the same thing someone brought up So I'm coming. Let me share my thoughts on that real quick. Kwabena Samuel said, can you touch on how double taxation is calculated? That is also another huge or lengthy aspect to calculate double taxation, because it's a whole thing I would have to do from, this is my tax book, from my tax book, and show you about it. But like I said, it's a whole thing. Maybe I could put the topic down, then maybe later on we could look at it as part of my topic slides here, double taxation, because that is a whole thing that we need to talk about. That's a whole thing we need to talk about. Lukman Jackman said, Nhyira, on page 91 of the ICAG question gate on console, I tried to use your formula to calculate goodwill, but was missing something. Can you take just the goodwill aspect? When you say page 91, which book are you referring to? Is it a financial reporting or page 91? Let's see. Page 91, Bantama. Okay. That'll be. I just want to see how the NCI was valued. Then that could provide me with the guidelines on how we calculate the goodwill. The fair value of insurance at the date of acquisition, Bantama, dividend of this. How was NCI valued? Oh, let me see. Payment test. It is a group's policy to value NCI at acquisition at its proportionate share of the fair value of the subsidiary's identifiable net assets. So you realize that when it comes to dealing with NCI, you have to be careful on how NCI is valued. There are three ways NCI is valued. NCI can be valued at fair value as determined by the directors of the company. It can be valued again at fair value using the share price of the subsidiary. It can also be valued using the net assets of the subsidiary. What happens is that if the NCI is valued using the net assets, their percentage of ownership of the net asset of the company, then in calculating goodwill, we will just have to take into consideration the fair value of consideration transferred, then you will less net asset, but you will less the whole net asset. You will less the parent's share of the net asset at the date of acquisition. And that is what gives you goodwill in that case. So that is the treatment there. So that was why when you mentioned it, I was like, let me look at how NCI was revalued. And once I know how NCI was revalued, then you will understand how the calculation was done in that regard. So I'm going to their solution so that I state to you exactly as well what was done there. I don't know if it is there. Okay. So let's see how they calculated their goodwill. So we realize that in the goodwill computation, they only took the issue in relation to the net assets of the subsidiary, their percentage of the net assets. That is what happens. That is what happens. That is what happens. So that is what you must take into consideration. If NCI is valued at percentage of net assets of the subsidiary, you have to calculate goodwill, and that is called partial consolidation, okay, or partial goodwill. So you have to take only the percentage of the parent ownership of the net asset in calculating goodwill. But if it is valued at fair value, then you do the full goodwill in that case. So look, man, that is the reason for that working. I hope that makes sense. John said, what is the difference between controller and auditor general from internal auditor general? What is IPF and the different type of IPF? What is the rationale behind establishment of. These are huge questions in public sector accounting and finance. But I don't know what you mean by controller and general audit general from internal audit. Like I said a moment ago, the auditor general is the head of the audit unit in the country. So he is responsible for the auditing of the various accounts of government. Two, the internal auditors are, or the internal audit agency are the people who are within each of the spending units to ensure that the spending unit is adhering to the laws of the country and also doing things the way they are supposed to be done. So internal audit units, they are in each of the MDAs and MMDAs. Then the controller and accountant general, he is the chief accountant of government, and he is responsible for the preparation of the final accounts of government, responsible for the preparation of final accounts of government. So that is the issue there. For your issue about Entosia, or whatever that word is called, it is actually an institution there mandated with giving guidelines on how auditing should be done in the public sector, And like I said, that is a big aspect. It's not something that I can just say and go away, because it's a huge aspect that I would have to spend some time on in that case. So we could add that as well, maybe to our topic slide. And if it is something we have to share our thoughts on later on, we could share some thoughts on that. All right. So any other questions? Or I could go back and pick some of the questions that were brought up yesterday during our discussion. The first thing has to do with business valuation. Somebody asked about this, that is financial management, and then the issue in relation to dividend valuation module. So let me share some thoughts real quick on that. Now, when it comes to business, so this is for financial management and corporate reporting, okay? Now, when it comes to business valuation, one of the methods there is the dividend valuation module. So this is where you are valuing the shares of the company using the dividend that the company is actually paying. And we have the constant dividend, which is PO 0 over KE. In that regard, PO 0 over KE. In that regard, let's put this on silent. Now, this is where we assume that constant dividend is paid. Constant dividend is paid. Now, note that when you are dealing with this business valuation issue, what happens is that you are going to be dealing with the issue in relation to dividend just paid. Okay, in other words, the market value you are calculating should be X div. Market value you are calculating should be X div. Now, when we say X div, it means excluding dividend. So you have to listen to the language very well. Is dividend about to be paid, or dividend has just been paid? If dividend is about to be paid, then the market value is going to be cum div. But if the dividend has just been paid, then the market value is X div. That is what you are looking out for in that regard. And always, we are dealing with the market value X div and not the market value cum div. So if the entity is paying constant amount of dividends in that case, then that means that we go with this formula to calculate the value of the shares in the business. Value of the shares in the business. KE is the cost of capital. Note that the cost of capital here could be either the traditional cost of capital or the capital assets pricing module. That could also be used there in that regard. However, sometimes dividends are growing for the organization. So if dividends are growing, then the growth rate would have to apply. So in that case, we say that PO equals DO 1 plus J over KE minus J. KE minus J. So this is why we have to look at it in that regard. So that is the idea about the growth in dividends. Now, so if there is growth in dividend, that is where you look at this. Now here, the J is the rate of growth. The J is the rate of growth. Now, when it comes to the rate of growth, there are two ways the rate of growth could be calculated. Now, the first thing is we could use what is called the Gordon approximation. The Gordon approximation. With the Gordon approximation, we say that the rate of growth is the required rate of return multiplied by the percentage of profit retained. So if, for instance, the company makes a profit of, say, $200, but then they pay a dividend of, say, $50, then what is the percentage of profit retained? The percentage of profit retained, which is the B, will be this, will be 150, which is the profit retained over the entire profit. And I think that should give you about 75%. So the profit retained there will be 75%. And you multiply that with the cost of capital, and that gives you the growth rate for the question or for the entity in that case. And that is what you would take into consideration and when we are making the decision about the growth rate. Then another thing is if, for instance, we are not given the structure of the question as this, then what we can do is that we would have to look at the past dividends. So in looking at the past dividend, that's why we say J equals the square root of N, the final dividend over the initial dividend minus 1. So here, what happens is that we could have something like the years coming up, the dividends that the entity is paying, 1, 2, 3, 4, let's say 200 here, 400 here, 500 here, 300 here. So in that case, your J is going to be equal to the nth root. Now, the way you determine the nth root is always to use the the number of period given minus 1, because the growth is this and this 1, this and this 2, this and this 3. So here the nth root is going to be 3. The final dividend is 300. The initial dividend is what? 200 minus 1. When you punch this out, remember the square root sign is not covering the one that we have there. It is just covering the fraction that we are putting up, and that gives you the growth rate. So when it comes to dividend valuation module, that is what you need to understand in that regard, where you are valuing the business, but taking into consideration the dividends that the company is able to pay for the period under consideration. The dividend that the company is able to pay for the period under consideration. Let me pull up Facebook. Let's see if we got some comments coming in from there. Okay. Other questions coming up. Hi, Nhyira. I need something about capital reduction. When you say you need something, what do you mean by something? Maybe be specific, then we can provide you with some answers. This internal audit is in place, but problems in terms of audit infractions keep on every day and night. Why? That is also another thing about weaknesses when it comes to dealing with the role of internal auditors, especially in the public sector, because, you know, sometimes these people have limited scope of work, And so it affects what they do, even though they are supposed to be independent, they are supposed to be given the resources that they need. Sometimes they don't have the needed resources, so they are not able to execute their work the way it's supposed to be executed. Then Lukman said, so in the case of Bantama, what is the value of TGE consideration transferred? What is the value of consideration? I don't understand. Like I said, the statement I made, I have not gone through to know the total fair value of consideration transferred, unless I refer to it to look at how much the value of consideration transferred is. Unless I go through that, but I don't think I have the luxury to go through that now because of the fact that we have a lot of issues to be dealt with though. But that should be given to us in the question 91. Yes, it is given to you in the question. You realize that Bantama acquired 6 million of Apripos Limited ordinary shares on 1st April 20X9 for an agreed consideration of 25 million. So that is the cost of the consideration transferred. That is the consideration transferred. So that is the idea there. That's the idea there. You are seeing in their solution that there is some pre-acquisition dividends because probably in the footnotes, and that is not part of fair value of consideration transfer. That's about net asset at the date of acquisition. So if there is anything like that, it will be in the footnote. But the fair value of consideration transfer is still going to be that particular amount there. All right, so let's see what else we got on our question coming up. Let's see. Maybe we can deal with other questions that has the people coming online. Yeah, someone mentioned something about transfer pricing yesterday. I don't know, I think Sharifa also. Let me share some thoughts on that real quick, transfer pricing. That's in man accounting. Now, the idea about transfer pricing, I think when I finish with this, I'll talk about the leases real quick as well. In that case. So the idea about transfer pricing comes to play because of the fact that we are having an organization that has various divisions. So there is one division within the organization that produces goods that is required by the other division. So we have division D and then we have division B. Division D produces the inputs that is required by the division B. The question we ask ourselves is, at what price should the division D transfer the goods to the division B? That is called the transfer price, or if you want, internal charge. Or if you want, the internal charge. So the transfer price or the internal charge. So the price at which the selling division transferred to the buying division or the other division is called the transfer price. But you must note that when it comes to transfer pricing, we need to pay attention to exactly what is going on in the scenario because of the fact that every transfer price policy must achieve what is called goal congruence. Goal congruence simply means that each division must do whatever it is doing in order to achieve its objective, but at the end of the day must ensure that the corporate objective is achieved. So goal congruence simply means that the selling division is selling at a profit, the buying division is buying at a least cost, hence the company as a whole is making profit at the end of the day. So the selling division is selling at a profit, the buying division is buying at a least cost, then the company as a whole is also making profit at the end of the day. That is what we mean by goal congruence at the end of the day. But a big question we ask ourselves is, okay, what is transfer pricing, or what should be the appropriate transfer pricing that the selling division will charge the buying division? What should be the appropriate transfer price that the selling division will charge the buying division in that regard? Now, there are methods through which we can use, or methods that we can use for the determination of the transfer price. For the determination of the transfer price, we have what we call the cost plus method. Then the second one is when we are looking at the capacity or resources availability. Capacity or resource availability. Then we can also look at demand conditions. When we say demand conditions, we are referring to external demand conditions. Okay, so usually I won't do this as a second point, as a third point. The capacity of resources and the demand conditions go hand in hand, or they go together in that case. So I'm going to be explaining them up together in that regard. So if we are using the cost plus module, like what do we mean? How do we arrive at the total cost in that case, or at the total transfer price? With the cost plus model, like you know already, it is where the transfer price is going to be the marginal cost of production plus the profits. And that could be a profit markup or a profit margin. Profit markup or margin. So it depends on exactly what is going on in the question. Either we are using markup or margin, then we can get a transfer price in that case. Now remember, if we are deciding the method to be used to calculate the transfer pricing, we are looking at it from the perspective of what? The selling division. That is the division who is transferring the goods in